Hello guys, as mentioned in my last video, I have picked 3 most recent market crashes and I'm going to show you how the returns compare between a lump sum strategy and dollar cost averaging strategy during these times. So let's go. The first market crash is the COVID crash. I timestamped it as starting on the 19th of February 2020 because that's when the price peaked. So you will see over the period from 19th of February 2020 to 2nd of January 2026. So the last trading day at the time of recording. So the results are the return for the lump sum strategy would have returned 254.67%. If you invested on the worst day possible, i.e. the 19th of February, when the price was at its peak of the time. At the same time, for dollar cost averaging, meaning if you invested $100 per calendar month since 19th of February 2020, then your return would be 160.98%. So in this scenario, lump sum strategy still wins. And we can also have a look at the chart here. So straight after the market crash, DCA strategy actually delivers better returns, recovers better than the lump sum strategy, which is understandable. But over time, perhaps after a year or so, a year and a half, then lump sum strategy seems to start overtaking the dollar cost averaging strategy and eventually outperforms as time went on. If you are interested in the exact numbers, you can request a copy of this spreadsheet in the comment section and I will share it with you. So next, let's have a look at the 2021 crash, which started on 19th of November 2021 when the price peaked. Again, if you had invested on the day when the price was the highest, your return to date would be, for the lump sum strategy, it's 18.2%. And for the DCA strategy, it's 134.05%. So that is quite a big difference. It looks like in this scenario, drip feeding really delivers. Again, my assumption for DCA is that you invest $100 every calendar month, whereas the lump sum is putting all of your capital in from the very first day. If we have a look at the chart, it's quite clear. For this particular period of time, which is about 4 years, you would have been much better off investing through DCA and not a lump sum. And finally, let's have a look at the 2024 crash, which I have timestamped as starting on the 16th of December 2024, when the price peaked. So if you invested then, your money would have returned 12.22% for the lump sum strategy versus 28.2% for the DCA strategy. So DCA delivers more than double the return. And let's look at the chart. So the chart shows as well over this period of about a year, the DCA strategy outperforms lump sum quite consistently. Given these results, combined with my previous videos, I'd say the lump sum strategy tend to really win over a very long period of time. But within a shorter times, like 1 to 3 years, perhaps, you're running the risk of experiencing a market crash and then significantly underperforming the DCA strategy. But it really depends on the market condition. For example, for the COVID crash, it crashed in 2020 and DCA strategy was outperforming. However, after the COVID crash, the recovery was so fast and in significant numbers, fairly quickly, the lump sum strategy started to outperform the dollar cost averaging strategy, probably after about a year and a half, which wasn't the case for the 2021 crash. Even after 4 years, the DCA strategy is still the clear winner and by a big margin. So really it depends on what the market condition is and how quickly the market recovers. Thank you for watching my video. I hope it has provided some useful information for you to consider how to invest in TQQQ as a long-term addition to your portfolio. Don't forget to like and subscribe to my channel for more videos like this. Bye for now.